Welcome to Telltales, an investing podcast hosted by Hunt Lawrence, Jason Wallace, and Mike Nicoletti. Each week, we discuss topics ranging from geopolitics and macroeconomics to energy and technology. You can sign up for our newsletter at telltales.us. That's TELLTALES.us for additional data and content you can use to follow along. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
The weather's definitely getting better. People here complain when it's not, at least 68 and sunny. So this weekend it'll be like 60 and not super nice. So. But we'll be in Omaha. Jason and I will be. So if anybody listening is going to be there, feel free to reach out to Jason and I. We'd love to say hi.
I also think that the annual meeting may be televised for people who don't go. I think you can watch it. Definitely.
I think CNBC does it, and they also stream it too. So
yeah. Let's start. I'm gonna try to have very little to say about the back of the 20 pages, the three exhibits. But let me get started. We've got only plenty of time because having spent a lot of time on Tesla last week, I think we're going to have to spend some more time on it this afternoon. On oil pricing, I just want to reiterate that there is 4 million barrels of surplus capacity being held off the market by Saudi Arabia, the Arab Emirates, and about 1 million barrels a day less Russian production because of Ukrainian drones. All that oil, if it came on the market, would take the price down significantly. The demand side of the market, I think, is in reasonably good shape, but that extra 4 million barrels of oil that could be added is a concern. On natural gas, the same situation, except that we almost have a natural gas OPEC. At least two of the significant producers in the Marcellus, EQT and Chesapeake, are curtailing production. I think between the two of them, it might be as much as 2 Bs a day. You look at Exhibit B, where the estimate is 104 for this year. The latest Platts numbers have it around 100. So that curtailing of production is welcome. Those two producers in the Marcellus can curtail production by shutting it in without any reservoir damage. Typically, it's not true in other basins. And if you look at the U.S. gas supply table on top, the Marcellus is 35 Bs out of 102 last year. The Permian, that'll all be produced. That's produced with oil. And it's actually an oversupply. So if you have gas out in West Texas, you get practically nothing for it. Or you may have to pay to have it be put in storage. Haynesville, I don't think can be curtailed. It's too complex a reservoir. But the Marcellus is almost kind of like an extension of storage. Exhibit A, U.S. government revenues and expenses. The foreign aid package for the Ukraine, Israel, and Taiwan passed almost $100 billion. No talk at all about offsets. I know I've sounded optimistic the last several Wednesdays, thinking that maybe we could hold the deficit at a $1.4 billion or $1.4 trillion or $1.5 trillion. Not consistent with spending $100 billion with both sides of the political spectrum proceeding without any offsets. That's life. Hopefully on the domestic side, they'll be more disciplined. Anything else on the macro side, Mike or Jason, you want to call attention to?
No, the U.S. government's looking to raise revenue with capital gains.
Oh, I'm glad you mentioned that, Jason. There's been some publicity about a wealth tax. And the idea is that it would be done on a multinational basis. It'll be organized by our Treasury Department, led by Janet Yellen. And I don't think our Constitution permits it. They had to pass a constitutional amendment to have an income tax, and I don't think a wealth tax qualifies as an income tax. But apparently there's a phalanx of economists and tax experts and whatnot. So either before November 7th or after, if the Biden administration is returned to office, we can expect something like that. It's been tried in Europe, and generally the really wealthy people move away. So I think France had a wealth tax, which was then rescinded. But that is definitely on the left side of the political spectrum, something that is being discussed. Anything else? Macro?
Interest rates are being held steady. So I guess we got that news from the Fed, but that's not a surprise.
Another thing that I meant to mention in macro, the real interest rate, in other words, the interest rate adjusted for inflation after 0809 got down to 50 basis points. Some would even argue it was lower than that. The real interest rate now, with the 10-year bond around 5%, with our inflation rate around 3 or something, is 2%. People on the left side of the political spectrum are hoping for two things. One, that the Fed funds rate comes down. In fact, on both sides of the political spectrum, they're talking about, does it really make sense to have an independent Fed? And secondly, they're hoping that the real interest rate goes back to 50 basis points. I think on both of those, even if Trump is reelected, and Trump is definitely not interested in independent Fed, and I don't think the Biden administration is, I don't see either side of the political spectrum actually moving on that. They can talk about it, but I don't think they're going to move on it. In terms of the real rate of interest, in other words, adjusted for inflation, I'm willing to go out on the line on this. When you're predicting things in the future, you try to be a little bit more than half right. I'm 80% sure that we're not going back to 50 basis points of real interest rate anytime soon. How can you? There's too much money that has to be borrowed by our government. And other governments are going to be inclined to deficit finance as well. So I think, 2% or 2.5% real interest rate, there's plenty of precedent for that in the years prior to 0809. I just don't think we're going back to 50 basis points. For those of you on the phone who have a 3% mortgage, I think you're kind of stuck where you live. I think you're just going to have to stay there or give up having that low interest rate. I'll pause again if there's anything else macro that we ought to discuss.
I'd agree with the interest rates. After reading The Price of Time, it sounds like historically around a 2% real interest rate is where most things settle out.
Yeah, and we'll see that I think Powell has a press conference this afternoon. Maybe he's already going on. He's expected to say that inflation has been stickier for the first 4 months of the year, and talking about maybe just one rate decline. I mean, the argument that interest rates were going to go down, it was going to help with budgeting, because now we pay as much on it for interest as we do on defense, was based on the Fed funds rate going down. The Fed funds rate goes down, and you have a bunch of financial investors who can borrow money at 2% and invest at 5%. Obviously, that 10-year bond would be inclined to come down. But if the Fed maintains a 5% Fed funds rate or policy rate, whatever they call it, because they're looking at inflation and seeing it's 3% or 3.5%, and 1.5% or 2% on top of that is where it would be. So if the Fed just didn't come down at all this year, in fact, there are a few economists who say it's not restrictive enough. The Fed should go up. You're going to be stuck with that 5% rate. So wherever the Treasury tries to finance, all the way from T-bills out to 10-year bonds, you're going to have to be paying that interest rate. They're not happy about that. Now the real answer is to not spend as much, to reduce the deficit, start getting the amount of the deficit as a percentage of GNP to decline rather than stay flat or go up, especially when they're running for national office. That's That's not something that does very well in polling or focus groups. So, don't expect to hear anyone arguing for lower spending between now and November 7th. And then, we don't know who's going to be in office this time next year. So now, does that mean you sell all your equities? I don't think so. But it is a concern. If you have a stock that you really want to own more of or start a position in, I definitely think this is a time to start a part position. What Mike and Jason and other people like them would call a research position. So if it continues to go up, you own some. But if the stock goes down from here because interest rates aren't cooperating with what the politicians want, at least you'll have an opportunity to add to your position at a lower price. Again, want to go back to Mike and Jason. I think I speak for the three of us, but each of them should speak on that issue.
No, we agree completely. And there will be more. My kind of view of where we are right now, just kind of expect volatility between now and November, and try to use it to your advantage. If there's something you want more of and it gets cheaper, use these drawdowns as opportunities to add to it.
Right. We got to go back to page 1 in Tesla. We don't have the Apple earnings yet, but we do have the Amazon, Alphabet, Microsoft earnings, and we have a lot of Tesla news. And I have a question for Jason. I guess directed at Jason. I understand that Musk sits down with the premier. I understand that they've made a deal with Baidu. So I guess all the information that's gathered by those cameras on Tesla cars will be somehow safeguarded by a Chinese company, Baidu. A little bit like the way the TikTok information is theoretically on Oracle servers and isn't available to ByteDance. But I mean, how practical is that, Jason? I mean, you come from a background where you've worked with these large databases and whatnot. I mean, is that a feasible solution, or to make sure that ByteDance can't access the TikTok servers or the servers that handle the TikTok information, or that somehow U.S. government can't get through to those information bases that are all the information gathered by the Tesla cameras, held by Baidu. I mean, is that realistic from a technical point of view?
Well, it certainly adds another layer of security to the data. I'd say if anything's on a computer, it's not safe. But I think it's a worthwhile measure for the CCP. So the data will reside within China, and then they have their pretty strict firewalls that won't allow the data to be accessed internationally. Not to say that there's no way that it's possible for that, but it'll make it more difficult for Teslas. They're not going to ship out the video of all the cars driving around sensitive locations in China back to the US. And that's the fear. So I think where the fear with TikTok is that the Chinese government themselves are going to access the data. It's less so with Tesla. Tesla might have access to the data, but it's not the US government that has access that they're trying to prevent.
Let me ask another question about that impacts Tesla, but also impacts Apple. There seems to be a trend in China, I mean, where their smartphone deliveries were up. In fact, Samsung's was up, but Apple's down across all potential people getting new smartphones. Is there kind of a be patriotic, buy Chinese rather than buy something that's incorporated in the US going on, do you think?
Yeah, we've spoken with a few people that live over there, and our views kind of narrow because these are people that were educated in the US, have worked in the US, and now have moved home. And I think in most cases, there's still more prestige associated with an American brand than there is with a local brand. But there's no question that whether you're talking about a Tesla or an Apple iPhone, the competition has gotten better, certainly in the last decade, but definitely in the last 3 or 4 years.
And in smartphones within the last year with the Huawei phone and the new advanced chips.
Right.
Mm-hmm. Right. What else do you see that's newsworthy on the page one companies?
Well, we obviously had the news about the cuts at Tesla and some cuts on the Supercharger network. Hunt, you and I talked this morning a little bit about that, and Jason and I kind of expanded on that conversation. And we kind of both had this realization that, oh yeah, remember in the beginning, the talk about the Supercharger network was really one of necessity, in that they were looking for a way to make sure that their customers had the ability to charge. Now that you have the IRA with a lot of funding that's going into building out the charger capacity, there's less pressure on Tesla to utilize its precious resources in order to do that. So it does seem like a calculated decision to allocate capital elsewhere.
Yeah, and I'll just add it, and I framed that news when I heard it as, none of the traditional automakers operate gas stations, and operating a gas station is a super low margin business. And if it wasn't for selling drinks and snacks, they wouldn't make any money. So maybe Tesla's looking at a future where selling electrons are very low margin as well. And I think that the new charging stations won't have the amenity there to sell drinks and snacks. They're largely that, they're in a Target parking lot or a grocery store. So that facility already exists. So maybe it's just not a business they want to be in.
Can I ask you a question? Well, both of you. Will use of the cameras in the Tesla self-autonomous driving, will the cameras enable your car or a robotaxi to learn? In other words, will your robotaxi or your own car or whatnot perform better over time because of the experience it has on the road system or the city traffic or what have you? Will it know to avoid a particular piece of road that has a lot of traffic? In other words, is it, what is AI? How much impact will AI have on autonomous driving?
I think it absolutely will. Yeah, they're evolving the algorithm and learning at every release. And then if in particular, locations and routes that a car might take, I even think Google's already doing that today in Google Maps. So it's probably enabled by some more traditional version of AI. And if you ask for Google Maps directions, it'll reroute you in areas that it knows are less congested, based on other cars, other users with Google Maps open, even if they're not using the mapping software at the time.
And then I'd add the more data that gets thrown into these models, the better in general it gets. So I think what you're saying is, like, in hyper-specific instances, if I'm the only Tesla driver that, has a Tesla in, we'll pick Center Island, right? That data maybe previously was never in the database, in the training set. And over time, as you were to map that spot, it will incorporate it. You may not see it directly, right? The result of your own data produced may not be directly impacted, but you'll see the overall effect based on everyone else's.
Yeah, I think it's less about knowing a specific road than seeing all the instances of variations of how, signs are presented to the driver or to the car, or speed bumps or that kind of thing. I do think there's a future as well where you can kind of train your car individually. So right now, I assume all of the FSD self-driving Teslas drive in the same manner, but I think there probably is a future where you could teach your car individually to drive more in a method that you desire.
Yeah, the one feature I know that they do have is you can set the level of aggression for like merging in from highways. So I think it comes default like kind of timid on the merging in on the highway, and you can dial that up and down to your liking. So they're experimenting with that sort of stuff.
There's a thing called the Pittsburgh left, where the first car in the line that wants to turn left when the light turns green gets to go and cut in front of the oncoming traffic. I wonder if it'll get regionally specific to do things like that.
I hope not, because I hate that.
How far behind is Alphabet, do you think, of OpenAI? Alphabet had awfully good results, very good cash flow, but are they getting flanked by OpenAI and whatever else comes down the road?
I don't think that they have less good technology than OpenAI. I think they have less incentive to release that technology. And I think that's ultimately the challenge with Google is it's a hugely profitable company with not a lot of incentive to innovate. Yet they do have some of the best engineers and some of the best talent to produce this stuff. But the question is at the end of the day, are they going to release a product that, is it going to impact their search business? So I think that they're in a better position to be a fast follower once a good product market is established, and they could fast follow and probably end up dominating that market rather than bother with doing the innovation themselves.
Yeah, I agree with that opinion as well. The one I'm worried about is Apple. In the last couple of weeks, there's been rumors they're partnering with Google's Gemini unit and now with OpenAI. And the question is, why do they need to do that?
I have another question about that would be a positive for Google. It looks to me like the Samsung Galaxy, AI features might be a competitor to the iPhone 15 or the iPhone 16 if Apple doesn't match it. Do you think that there might be a trend away from Apple iPhones to the extent that Samsung has more AI features?
Okay, so my thought on this topic is if I am Google, the right thing to do is enable all of the apps on the App Store. I'd say the Google App Store, or the Google Play Store, enable them to be able to utilize my generative AI services by creating the technology that is needed to run these models on the phone, making it easy. You can kind of generate your own market, if you will. So we've seen some of the AI-related features make their way into the Google Gemini phone, or whatever they're calling their kind of AI-enabled phone. And you'll see those same features kind of trickle into the Samsung phones and some of the others. Presumably, they're talking to Apple about something similar. Because if I'm Apple doesn't operate a cloud services center. Those apps generally use AWS or some other. Their closest relationship is Google. They want to make sure they enable the most developers possible. So if they're talking to OpenAI and Microsoft, they're probably also talking to Google and Amazon. So however they wind up doing it, I don't know. The question is, does Google actually care at the end of the day whether somebody has an Android phone or an iPhone? Because they're monetizing them either way. And I don't actually know the answer to that. And maybe some others do. But I think in general, Google wants more people using more of its services. And whether that's search or their cloud services, they're just looking for ways to expand that.
When will Apple have their developers conference? Is that June sometime when they'd be expected to unveil an upgraded Siri or whatever they're going to call it?
Yeah, June 10th. So soon.
When you look at the first quarter results, now we have Amazon Web Services and we have Google Cloud, pretty much backs up what you and Jason, the two of you, have been saying about no matter how expensive those NVIDIA chips seem to be, the H100s, that whoever's buying them, if they have cloud business, get their money back pretty quickly. Because it's definitely a pickup in revenue growth for the cloud companies.
Yep, exactly. What we had seen before, I think the payback period maybe is a little longer, but at some point the payback period was under 12 months for an investment in some NVIDIA servers. And you see that sort of in the cloud service providers numbers. AWS has grown, Google Cloud has grown, Microsoft Azure has grown, and it's grown on an operating margin percentage as well. And that operating margin, remember, they depreciate the value of those servers over a period of time. And I think they're not all exactly the same, but let's just say they're all 3 to 5 years on average. So if you can get payback in year one, so your cash flow or cash returned in year one, that means it's going to be all gravy down the road. And then from an operating margin percentage, you're taking the depreciation. So it's a relatively high dollar value product. And so you're recognizing a lot of operating margin as well. So it's a good business.
And we saw the operating margin at AWS. Did it triple? It went up by a large amount.
Right. And you see every single one of these guys are planning to invest, call it $40 billion next year or this year on average in additional capital expenditures, which are the vast majority of them are going to NVIDIA servers. So, it's funny how these things play out, but it is. Jensen Huang, CEO of NVIDIA, the other day, and I'm probably taking this a little bit out of context, but essentially he said, our customers wouldn't even take our competitors' products if they were free because they wouldn't be able to make money on them, even if they didn't have to pay for them. And so you look at NVIDIA and say, oh my goodness, these chips are so expensive, but their customers are making money with them.
And the math still must work out because their projected CapEx budgets are going up dramatically as well.
So we haven't looked at page 3 in a while, which is the NVIDIA page. NVIDIA doesn't report earnings. They're a month out of kilter, so their fiscal year ends in January, so we won't see NVIDIA earnings for a while. I have it at a $60 billion sales rate, which must be the lowest of anyone who's looked at NVIDIA. I think most people are at least 80 billion. But I mean, you go from 60 to 80, that free cash flow is going to go from 25 to 40 because the margins are so high on the GPU chips. So if the thing has on a kind of a conservative look without projecting too much future, 40 billion of free cash flow, it's starting to compete with the companies on page 1. I mean, Apple at 88, Amazon, I guess, adjusted for the first quarter results, going to be kind of in the 40 billion range. Alphabet at 53, Microsoft at 62. Just really quite extraordinary. Kind of dwarfs everything else on page 3. I mean, AMD, I make it 5. Intel is about a $15 billion free cash loss. Taiwan Semiconductor continues to spend a lot of money. So they're the ones that make good chips, but they're kind of break-even free cash flow. And then ASML, which makes the key equipment to make these, is, I don't know, 5 or 6 billion of free cash. It's really pretty lopsided, isn't it? For a guy who built a company who was just viewed as making chips for gaming, it's really just kind of a remarkable turn of events. I mean, unprecedented, I would say, in terms of if you sum up all chips, all software, all biotech, things we like to look for where you have way above average growth that isn't really impacted by macro things. I mean, I can't remember anything like NVIDIA in terms of how they've taken over the high ground.
Yeah, and I think he's a unique founder because he's one of those guys that can kind of see around corners. And the initial product, right, was a graphical processing unit, not necessarily derived solely for gaming, but what he recognized is that computers were shifting from a terminal, right, where you just interface with text with the computer, to a graphical interface. And he made the logical conclusion that CPUs are really bad at rendering graphics. So it would make sense to separate this out. So that first step was so unheard of back then. And if you look at the history of Microsoft, even Microsoft wasn't really sure that this graphical Windows 3.1, I think is when it was the first one, they weren't sure that was going to take off. And people obviously loved it. And the concept of a mouse and being able to visualize what you're working with on the computer, I mean, that was profound. And the fact that Jensen was able to say, hey, this is the direction, not only this is the direction it's going, I'm going to build a piece of hardware that makes this better. So that's one of many innovations that they've been well in front of. This one, I mean, even we who were early on the machine learning stuff and computer vision stuff back in 2015, 16, we could have never guessed the scale as to how big this was going to be. So we'll keep looking for more Jensen Huangs, but they're few and far between.
Yeah. Well, we've run out of runway. We haven't talked healthcare. Jason, any healthcare developments in the last couple of minutes you want to point to?
There's some positives to take away from Pfizer's earnings report. If you pull out their COVID-related businesses, sales were up 11% year over year. So they're starting to turn things around. Fear still is they're putting a lot of focus on the COVID treatments, and at least in my bubble, that no one's been contracting it or worrying about it in quite a while. So now their latest push is to do direct to consumer on those treatments, on the vaccine and the treatment for it. So eventually, I think they turn the corner. They've had some positives. They had a gene therapy approved last week, so that's kind of interesting.
Right. Good. Well, we've run through our 30 minutes. Everyone, be healthy, stay healthy, and we'll be on next Wednesday. Take care, everyone. Bye-bye.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.